Imagine a bustling market square where everyone suddenly decides they need their coin purse filled to the brim right now. What happens when the money changer does not have all that cash immediately on hand, even though they have many valuable assets? This is a bit like the situation banks can find themselves in. We are going to explore a key concept called bank illiquidity during a run. So, what does bank illiquidity mean during a run? Simply put, it means a bank does not have enough readily available cash to meet the immediate demands of its depositors who are all trying to withdraw their funds at once. It is crucial to understand that an illiquid bank is not necessarily an insolvent bank. An illiquid bank might still own valuable assets that exceed its liabilities, meaning it is solvent, but those assets cannot be quickly converted into cash without a significant loss. The core reason for this lies in the very nature of fractional reserve banking, which is how most modern banks operate. When you deposit money, the bank does not just store it in a vault waiting for you to come back. Instead, it lends out a significant portion of those deposits to individuals and businesses for mortgages, loans, and other investments. The bank only keeps a small fraction of deposits as reserves. This process is known as maturity transformation. Banks take on short-term liabilities, like your checking account balance, which you can withdraw at any time, and use them to fund longer-term, less liquid assets, like a 30-year home loan. During a bank run, if a large number of depositors simultaneously demand their money back, the bank quickly depletes its cash reserves. To meet further withdrawals, it would have to sell its long-term assets, such as loans or securities, often at fire sale prices below their true value. This forced selling can quickly turn a liquidity problem into an insolvency problem. Understanding this mechanism is vital when studying historical financial crises. Many historical bank runs were triggered not by a bank truly being bankrupt, but by a sudden loss of confidence. Rumors, economic downturns, or even the failure of a different financial institution could cause depositors to fear for their money. This fear would then create a self-fulfilling prophecy, as the sudden withdrawal demands would render even a solvent bank illiquid. Knowing this helps us analyze why certain interventions, like the establishment of central banks as lenders of last resort or the introduction of deposit insurance, became essential tools in managing financial stability. The concept of a liquidity crunch is closely tied to bank illiquidity. This happens when there is a sudden and severe shortage of available funds for lending or borrowing in the overall financial market. Historically, the response to these crises often involved a central bank stepping in as a lender of last resort. This means the central bank provides emergency loans to solvent but illiquid banks, allowing them to meet depositor demands and prevent a wider panic. This mechanism helps to break the cycle of fear and restore confidence in the banking system, buying time for the bank to restructure its assets if needed without forcing a fire sale. Ultimately, bank illiquidity during a run is a powerful demonstration of the fragile interplay between a bank's asset structure and the confidence of its depositors. It underscores how the fundamental role of banks in channeling savings into investment also exposes them to the risk of sudden cash shortages. Effective financial systems, therefore, relying on robust liquidity management and strong safety nets to transform potential crises of confidence into manageable situations, preserving the flow of credit essential for economic health.